In this video, we're going to talk about the security issuing process. How do companies get securities to the public? Well, if you're issuing common stock, and bonds are not dramatically different from this, but if you're issuing common stock, this can be done through what's referred to as private equity, right? We can take what's referred to as an external equity financing. We can find a few companies, maybe a few individuals, and we can get those to help us to finance some early stage kinds of firms. So this is external equity. So it means we're going outside the company and there is an ownership piece to this investment. Now, angel investors are typically wealthy individuals, right? They just make decisions on their own. People find them or they find people and they exchange money for some form of equity. If you think about Shark Tank, this is what they are. They are angel investors, individuals who are investing. Now, we also have what are referred to as venture capitalists. These are typically more companies, right? They're formal business entities. They could be partnerships, they could be corporations. But again, the idea here is that they provide funding to typically emerging companies that are trying to grow and become obviously bigger players in their marketplace. Some of the times we also have these entities could be limited partnerships, right? In fact, that's usually the most common kind of structure of these venture capitalists. Rather than corporations, they're partnerships. So how does the structure work? Well, essentially, there are responsibilities and ownership interests that are discussed between the existing owners, the founders, and this venture capitalist. Now, depending on the talents of the existing owners and the resources of the venture capitalist, it can take a lot of different shapes and forms, if you will. Now, if you watch Shark Tank, what you'll find out is in the end, the sharks provide X amount of dollars for a certain percentage of equity. When they take this equity position, because they are an owner, that means they assume some types of control. And this is why you'll see sometimes they'll argue not so much about the money, they argue about the equity. How much control will this person take? And most entrepreneurs don't want to give that much control, right? So again, how this works, it's a negotiation process dependent on how badly the company needs the funds, the kind of business it is, and sometimes the complementary skills that come from, in this case, the sharks. Can they help or not? Now, if you're thinking about going public, we're actually going to provide shares to the public. There are three basic ways that this happens. One way is what's referred to as a private placement. In this case, we're going to sell some securities directly to an investor or to a group. So we've identified some people. Maybe we don't need, $500 million. Maybe we only need $30 million. So maybe we have a group of investors we can go to for this money. So it's a private placement. Now, there are some very strict rules and regulations on what those shares can be done, what you can do with those shares. So it's not like it's a back door, we're hiding things, right? People know that this happens, but there's also some very strict rules. There's also what's referred to as a rights offering. If the company already has shares that trades, we can offer a stock right which allows the existing shareholders to purchase the shares at a certain price. And then finally, there's something called a public offering. An initial public offering is the very first time. But this is basically when we just offer the entire issue to the general public. So, and again, we talk about initial public offering is when this happens the very first time. When securities are first traded, there's something referred to as a prospectus. This is a requirement for registration. It gives all kinds of information about the issue, this issuer, etc. But it basically lets investors know the key characteristics of the issue, the company, its risk positions, etc. That's the prospectus. Now, when can a company sell their stock? They have to have a prospectus. But in the meantime, because it takes some time to get this prospectus, the company wants to get some interest in the stock. So they'll provide something called a red herring. It's an incomplete prospectus. So it's just a preliminary document. Most of the information is there, except for things like the number of shares, the price. Those things are missing, but you get all the risk analysis, information about the issuer, etc. Now, when this thing is in registration, right, it's at the SEC for approval, it's what's referred to as the quiet period. So during this time frame, there's very limited information that can be provided by the company or the investment bankers about this particular issue. And the reason is we don't want to provide information that might not be 100% true. Just because things in the economy do change, right? So risks change. A roadshow is when, again, it's kind of self-defining. They go out and they start talking about the share so that they can gather some information about investors. Now, what does the investment banker do? The investment banker essentially is an advisor. They help the company determine what kind of security, what kinds of prices to offer, etc. And that whole process is what's frequently referred to as underwriting, right? So when they underwrite this security, what they do is say, look, we will take all these shares, for instance, and we will buy all these shares from this company at $20. Then they go out and they sell it for what they think the market is. Let's say it's $25. So they make $5 profit on every share they can sell. The company gets all the money they need because it's the prices determine how much they have to raise at a minimum. So again, this agreed upon price for underwriting provides the profit for these underwriting banks. So what are the roles that they do? Again, as we mentioned a second ago, this is pretty risky for the underwriters. What they typically will do is diversify away some of the risk of getting rid of all these shares. So they will create what's referred to as an underwriting syndicate. It's just a group of other marketers that will help them distribute the shares. Again, just some other terminology. A tombstone is basically the advertisement that goes into the newspaper, like the Wall Street Journal. Again, the syndicate, they also sometimes refer to as a selling group. Again, these are a bunch of brokerage firms that work with these investment banks to help distribute the shares. So what is the role of investment bank? Again, so let's think about some math, right? What are the total proceeds for all the shares? The total proceeds is the Ipo price multiplied by the number of shares that were issued. The market price is the share price that's determined by supply and demand in the secondary market. And the total market value of the company, the market capitalization, is the market price of the stock times the number of shares outstanding. So what else do we need to know? The Ipo market price. This is the final trading price on the first day of trading. We know that there are times when there could be what they refer to as underpricing. That is, that the market price is less than what the offer price is less than the market price, right? Because the offer price is essentially what you have to pay for this, but the market price could be more. So essentially, there's a premium, if you will. So if you take the market price and subtract the offer price, divide that out, that gives you the underpricing percentage. So here we have an example of this company where the market price is $22.50, the offer price was $22. So when you do the math, 2.27% is the offer price. So the stock was actually sold. Again, the market price is at the end of the day. It was sold with essentially a profit at the end of the first day of 2.27%. Now, that doesn't sound like a lot, and quite frankly, it's not that much. There are certainly times Snap Incorporated had a 44% underpricing. So from what it sold for initially to what the price was at the end of the day, there was a 44% difference in that, right? So again, the outcome of this transaction is very uncertain. There were some issues recently with Facebook's initial public offering 3-4 years ago, where basically the underwriters really messed up and they really overvalued what Facebook was worth in the beginning. So quite frankly, the Facebook wasn't going to get as much money as they thought they were going to get when they had opened this transaction on the day of the IPO. Again, it's a little bit of an involved process. Again, I hope you like the video. I'll talk to you next time.